Hey everyone, welcome back to Chipstock Investor.
Hey y'all, I'm Nick.
And I'm Kasey. Alphabet has reported their most recent earnings, and we're going to take a look at their capital expenditures and the rapid return on investment that they're getting from those expenditures. We're going to start out the discussion by looking at this chart right here from our friends at fiscal.ai. They're the sponsor of today's video, but don't fast forward. You're going to want to look at this chart.
We've been making this chart with fiscal.ai, formerly FinChat, for well over a year now. And as this whole AI data center and CapEx boom, since it got started about 3 years ago, this metric in particular, CapEx to revenue, has become more important than ever. It's one of the first things that you need to look at to be able to judge important long-term shareholder return metrics like return on invested capital. And Fiscal gives investors a great way to visualize these trends over the long term, like what you see here. In Q2 2025, the capital expenditures, mostly on logic AI servers, they said about 2/3 of the servers they purchased skewed towards logic and GPUs, the other third networking. Those are the servers that help manage and move data around the data center. You can see that the CapEx to revenue matched the previous quarterly high point of 0.23 CapEx to revenue.
The last time that happened, Nick, was all the way back in Q1 2018. So what's different now?
Well, obviously what's different now is we have this brand new secular growth tailwind that is, Wall Street likes to just call it AI, but really it's actually much broader than that. It's accelerated computing, of which new AI methodologies are one of the largest use cases for accelerated computing. This number does definitely look elevated, and this level of CapEx isn't sustainable. However, as you can see, even from this brief snapshot chart over the last decade, CapEx is actually cyclical. So at some point, the CapEx to revenue ratio will come back down. And in the meantime, we'll get into this here just momentarily. We'll explain where the money is coming from to pay for this and why Alphabet is actually in really good shape to continue this trend. And ultimately, we think, come out on top of this new AI race.
If you want to analyze businesses like we do here at Chipstock Investor and dissect them via these wonderful metrics, check out fiscal.ai. You can get 15% off any paid plan, fiscal.ai/CSI. Now let's take a look at the actual dollars and cents that were spent on capital expenditures in this most recent quarter. Q2 spent $22 billion in CapEx. Last quarter, they spent 17, and they're raising their outlook.
We are fully into the CapEx race among the big hyperscalers. So we saw Meta do this last quarter. Now Alphabet's doing it. Probably going to see some of the others do this as well. Microsoft, Amazon, probably Oracle. 85 billion in CapEx is now the expectation for 2025, up from 75 billion previous outlook. So lots of spending on semiconductors. The majority of this is their technical infrastructure, which in the past we've broken that down. Basically, that's just the actual computing infrastructure part of the data centers. So bulk of this is that. 2/3 of it still logic servers, so GPUs. NVIDIA is probably going to gobble up the majority of that. And then the other 1/3 networking. Pretty huge increase to the CapEx for Google and Google Cloud. In spite of that CapEx, though, this is still pretty incredible. Cash provided by operating activities minus CapEx gets you free cash flow. And with the big increase in Q2, of course, no surprise to see free cash flow in the quarter at 5.3 billion, down significantly from the previous year. But on a trailing 12-month basis, this is actually still looking pretty good, right?
Yeah, still it's over 66 billion, up 10% year over year. Lots of free cash flow.
In spite of the huge CapEx bill. Yeah, Google's just got really deep pockets. Really frustrating to hear people still talk about this company getting disrupted. They're being challenged for sure. Disrupted? No, not exactly. High level stuff here. consolidated statements of income. What we thought we would do, though, because this obviously gets tons of coverage on social media and news networks breaking down the revenue growth and the earnings per share and whatnot, it was good. But we thought we would just do a brief reverse discounted cash flow for you. So we're pulling the share count from the far right. You can see the share count continues to fall. That's thanks to Google's share buyback program. So we're going to pull that number there on the far right, the 12,245 share count. And we're going to use that trailing 12-month free cash flow of 66.7 billion and divide it by the share count that we just showed you. And here's a reverse DCF to try to figure out what the market is pricing in today at a share price of just under $200 a share. And this is what we've come up with.
Okay, so that gives us free cash flow per share of $5.45 and GAAP earnings per share of $9.39. And we're going to use simply earnings per share because of that outrageous CapEx right now. 8% earnings per share growth over 10 years, 3% terminal growth rate thereafter with a 10% discount rate gets us to around $200. So is that reasonable?
Yeah, it definitely, Google continues to get discounted heavily because of all of the issues going on with, are they going to get broken up because of the antitrust trial? What kind of penalties are they going to face in Europe? So there's a lot going on. Also, of course, the elevated CapEx, but remember that's a cycle and the CapEx cycle will eventually decline and that free cash flow number will pop higher as a result. So that's why we're just using GAAP earnings at this particular point. But based on this, and if you assume free cash flow reconverges with the GAAP metric again at some point, we continue to think Alphabet, Meta, and Amazon are still very, very reasonably priced for those of you that might be looking for positions to add to your core portfolio. It's still quite reasonably priced for the long term. And I think you can see that here in the implied growth outlook the market has baked into the stock price right now. It's quite low.
We're going to have much more discussion on this and all of the other companies that are reporting in coming weeks over on Semi Insider. Check out the link in the description below or here on the video. Gets you access to all of our content, all of our articles, and live events.
Yeah, check it out on chipstockinvestor.com, and we'll see you there over on our Discord server. Take care, everybody.
See y'all again soon at Chipstock Investor.